Hi, I'm Rebecca Katz of the Vanguard Group, and I'm here with Joel Dixon, a principal in Vanguard's Investment Strategy Group. So Joel, there seem to be a lot of ETFs in the marketplace today. How is an advisor supposed to pick between them?
Evaluating an ETF in many ways is just like evaluating any other investment. So what is it you're trying to achieve with the investment in terms of the exposure, and what's the quality of the management, and what are the costs that are involved in getting that exposure?
Now, you talk about costs. I mean, should that be the driving factor, especially if you look at two ETFs that track a similar market, say large cap stocks?
Yeah, and there is, with a proliferation of options out there, often there are competing options in a particular category or segment. I like to think of the evaluation of ETFs versus similar approaches in sort of three broad areas. So the first would be the management of the portfolio. So you might have two large cap ETFs. Are the benchmarks the same? Are they different? Do you prefer one of the benchmarks to the other? But even apart from that, how closely do the managers track their underlying benchmarks? Because in fact, you can have, even targeted to the same benchmark, say S&P 500 in the US for large cap stocks. Managers may have different experience in actually being able to track that benchmark, because they might have fully replicated approaches where they hold every security in the index. They might have sampled approaches where they hold only a portion of the securities. Or they may even use derivatives to gain the exposure to the index. Each of those has benefits and risks associated with them that you as an investor or an advisor should understand. Some may be subject to more tracking error than others, and that variability may be something that you may not want in your portfolio. The second group of sort of area to consider would be what I call the ongoing costs. And that basically is the expense ratio of the investment, one compared to another. And all else equal, lower expense ratio, lower cost, better off over time. And then the third would be the execution costs, or the costs that are incurred at the time you buy or sell the ETF. So that's going to include things like bid-ask spreads, commissions that you might have to pay, as well as any premium or discount that might be related between the net asset value and the market price. And we talked about that earlier in terms of supply and demand forces, but sometimes if the underlying benchmark or the way that the benchmark is being managed against by the manager is less liquid or subject to more variability, there could be different premiums and discounts. And it would be good just to know what the average premium and discount is for a particular fund and to put that into the evaluation. So overall, management, ongoing costs, execution costs sort of have to be evaluated together.